Right, I think everyone's joined who's going to join. So welcome everybody to our first webinar of the year. Hopefully one of many, bringing you sort of insights into various sort of topics and tax strategies that we think are important to the client base. We're doing this one in collaboration with Pareto, so I'm very glad to have on the call Joseph Warne from Pareto. Joseph's going to share some information on salary sacrifice and the benefits to the team and cost savings that you can get on by implementing a salary sacrifice arrangement. We've got Pete Roster here, head of tax at Sempar. Pete's going to share an update on the budget and revisit the announcements that were in November, as well as some year-end tax planning tips as well. And then I'm going to hopefully link the two of them together with a little bit of cultural focus and key team retention. So without further ado, I'll introduce you to the first speaker, which is Pete Roster, our head of tax here at Sempar. Over to you, Pete.
Good morning, everyone. So today I wanted to touch on the spring statement, if there's any updates there, and then also look back at the autumn budget. So spring statement was very little. So the spring statement, there was nothing really to note in terms of tax. So we thought it would be a good opportunity to review what happened in the autumn budget, and that is one of the reasons we're here today, because of some of those changes and what we can do to help. So the first main one, again, why we're here today, would be the national insurance increase. So national insurance for employers went up to 15%, and that starts in April. And there was also a reduction of the threshold for when you start paying national insurance, which reduced down from £9,000 to £5,000. The only upside was there was an employment allowance increase to £10,000. Another thing that changed in the budget was in relation to capital gains tax, and they changed the rates, so all capital gains is now at 18 or 24% instead of 10 and 20% for anything other than residential property. Further to this, they announced that the business asset disposal relief for many business owners who are selling their business is being phased to a higher rate, and up until the 5th of April this year, we've got 10%. After that, we've got a 14% tax rate, and moving on to 18% from 2026. We also, pensions have historically not been included for people's estates for inheritance tax, but that is going to be introduced from April 2027. So tax planning for inheritance tax, that has brought in more reasons to have a look at your estate from inheritance tax perspective. And then the final big thing was stamp duty for second properties changed from 3% up to 5% an additional stamp duty level. So what I wanted to do is just have a look at why pension can be important, and also look at any other tax plan tips as we're coming towards the end of the financial year. So for business owners, pensions can be a really good way to extract money from your business, because you don't pay any income tax on pension contributions if they fall within your annual allowances. You also receive corporation tax relief of up to 25% on those contributions. When you're looking to take that money out, you can, once you reach pension eligible age, you're able to take 25% out tax-free, which means that you're not paying any income tax on putting it into the pension, and then you're potentially getting a quarter of it out tax-free. Pensions are flexible. They're not just for investing in cash. People can use them for commercial property, and also in some cases you can use it to loan money back to the business for trading businesses, therefore recycling the cash with a tax-free uplift from the corporation tax savings and using them to maybe use the commercial property that you use in your trade, or like I said, it money back into your business. And then finally, it's looking at you now and in the future. So instead of trying to pay an income tax at 40 or 45% of your earning, and then keeping that in savings, and then using that money as you retire, with pensions, you're able to get tax back or reduce the amount of tax you pay as an individual when you're earning, maybe bringing that down to a 20% level, and then taking that money out in the future through pensions at a 20% level, therefore flatlining your earnings over your lifetime rather than having a spike when you're in employment and a dip when you're in retirement. So what is the pension annual allowance? The pension annual allowance, every year an individual gets a certain amount that they can put into a pension without income tax. So that is currently at £60,000, and that includes your employee contributions as well as your employer contributions. There is a limit of what you can put in as an employee if your earnings are not more than £60,000, and that is 100% of your annual earnings. But this restriction isn't for employer contributions. And there are additional threshold rates if your income is above £200,000, and then you may not get the full £60,000. On the upside on that as well is that people are able to use unused relief from earlier years. This can be subject to certain conditions, but currently there is available the current year of £60,000 plus the previous 3 years, which could be a total of £200,000 worth of allowances that you have available to put into a pension. So wanted to concentrate on a couple of areas where pensions can be quite useful for mitigating tax, and where people might not be claiming tax relief. So when you have a pension relief at source, which Joe will talk a little bit more about what kind of pensions you have as an employer or an employee, but one type of pension is a relief at source pension, which effectively means that the pension gets taken off after deduction of tax and national insurance, thereby the government top up 20% into your pension. But if you earn over £50,000, you may be eligible to claim an additional 20% tax relief. And this can either be done through doing a self-assessment, or the government do have a portal to be able to claim that relief. A further point is when you have income above £100,000. So everybody gets a tax-free allowance of £12,570, which means that your first £12,000 is income tax-free. But as you earn over £100,000, you start to lose that. For every £2 you go over, you lose £1 of that personal allowance, which effectively means once you get to £125,000 worth of employment income, you have lost your personal allowance, and therefore that £25,000 is effectively taxed at 60% rather than 40%. To be eligible to that £100,000 income that you relates to losing your personal allowance can actually be extended if you make personal pension contributions. So if you are just over that barrier, it's worth considering whether you should put personal pension contributions into your pension before the end of the financial year to mitigate this, because the tax saving can be quite substantial, and actually your net money in your pocket might not be drastically different, and you're also saving for the future of your pension. This is also the same for charity donations. So if you're on that cusp, it is making sure that you are recording those and claiming for those charity donations to be able to increase those bands. Another thing pensions can help is child benefits. So child benefit in 24-25 did increase to £60,000. So previously it was at £50,000, and if as you earned over between £50,000 and £60,000, you lost all of your child benefit. This is now at £60,000, and for every £200 over £60,000, you are for income, you lose 1% of your child benefit. So if you, for example, earn £65,000, you would lose 25% of your child benefit. And if you had 3 children, for example, in 25-26, that would be roughly £750 worth of your £3,000 child benefit that you have lost. So one thing people don't realise is if they are on the relief at source pension, then that can offset against what your taxable earnings are for this threshold. So if you have, for example, £2,000 worth of employee pension contributions in the year, and you've got earnings of £65,000, then you're only assessed for child benefit on that the difference between the £65,000 and the £62,000, which is the earnings limit plus the £2,000 of your pension contributions. So that's in the main in terms of pension planning and how pensions can be useful. So we just want to touch on a couple of other bits before the end of the financial year that can be really beneficial. So using your ISA allowances, there was talk about this, the cash ISA being reduced in the spring statement, but nothing was changed and that I'm aware of. So you're still able to put up to £20,000 a year into an ISA. This is a use it or lose it sort of benefit. And with interest rates at a fairly decent level now, we are noticing more that HMRC are reaching out to people where they've got interest in normal savings accounts, and they're putting that into their tax code to make sure that the tax is being taken from them. So by putting it into an ISA helps you to grow your cash tax free, because any interest, dividends or capital gains that are incurred whilst the money's in an ISA are completely tax free. So you making sure you're using your ISA instead of having it in general savings account can be really beneficial. As well as that, if you've got other spare cash, using it helps start saving for your children. So you can use junior ISAs if you've already utilised all of your ISAs to be able to grow tax-free funds to your children, and then they will be able to convert it into a regular ISA when they turn 18. So again, another allowance that's a use it or lose it is your tax-free capital gains annual allowance. So unfortunately, this over the last few years has been reduced to quite a small level. So it is now at £3,000, but it can still be beneficial if you are looking at making small gifts or you're looking to sell stocks and shares, making sure you're using this allowance rather than just rolling up all the gains for a future event and then potentially getting taxed at 24% on some of those gains. And then finally, just to touch on inheritance tax, there are certain elements that you're able to gift children or other people cash every year. So for inheritance tax purposes, you're able to gift however much cash you want to do every year without any tax charges. However, if something happens in the 7 years following those gifts, then they can come back into your estate for inheritance tax. So utilising small annual exemption allowances every year to gift to people, these elements, if something does happen in 7 years, do not get caught inside your estate. So again, they're not a use it or lose it, but you can only go back from one previous year. So the maximum you can give in 1 year without it being caught into inheritance tax in the future is £6,000. But there are also small gift exemptions for other individuals that haven't utilise the annual exemption of £3,000 of £250 per person. And then the other one that can be quite important for inheritance tax is gifting out of regular income. So if you are earning a pension and you've got income from from your employment, and you're not using all of that money to support your quality of life and your standard of living, you're able to gift some of that income tax-free. And if anything happens in the 7 years, then that wouldn't fall part of your estate. And finally, there are just a few exemptions, which are further exemptions for wedding gifts. If you were to gift your child, or grandparents were to gift their grandchild money for a wedding, then again, these don't need to fall into someone's estate if something happens within 7 years. But making sure if you do any of this, it's recorded properly, so that if something does happen, the executors of the estate understand why and how these gifts have been made, and make sure that they're not included within your estate for inheritance tax. So I know I've just ran through that quite quickly, but it was just to give a quick update on everything that can be done pre-year end. And I will then therefore pass back on to Steve, who will talk a little bit more about business growth and retention of employees.
Thanks, Pete. Some really valuable points there, and just a reminder of some of the changes that were in the budget. Just a reminder to all of our attendees that if there's any questions that you've got on any of the technical content, then on the top of your toolbar there's a Q&A button. If you just launch the Q&A button and type any questions in there, that we will come to questions at the end. So as we go through the slides, if you think of anything, just drop it down in there, and then at the end of the session we'll go through any questions, and obviously we won't repeat any, but we'll try and answer everybody's questions before we end the webinar. So obviously a lot of salary sacrifice is around cost saving, but it's also around how you treat your talent, and for a lot of businesses, their employees are one of the biggest assets they have. So it's really important that we think about actually the cost of retention of good people, and some of this, I've done a little bit of research into some of the stats here, but actually the true cost of losing an employee or losing a team member is a cost of around 125% of that person's annual salary, which is really interesting when you start to think about actually all of the costs of somebody leaving your business. The re-recruitment of a new person, the time and interview process, retraining, everything to bring that person up to scratch. Effectively, you will have lost productivity in the time that you maybe have a gap between people, and you have ultimately the cost of the person exiting the business. So it's really important that we think about when we're making savings, or when we have choices of making the environment and culture better, and we think about benefits that we're offered to people, that we think, well, how do we maybe use some of those savings to win in the longer term? And we'll come on to the rewards of that in shortly. But if you just look at the reasons in which, so this is from a survey in 2024, and the reasons in which people leave organizations, the top reason is lack of progression, so career really, and sometimes not always anything you can do about that. You can't build your organization around one individual's progression and career, but obviously it's something that's of importance to most employees. Leadership is a common reason why people leave, but then we're into things that we can necessarily control. So better benefits, work-life balance, and better engagement are things that maybe we can do better as employers, and we can improve the conditions that our team work in. And so, when we're looking at cost savings, so obviously Joe's going to go through a lot around the salary sacrifice and what that means for the employer, and how the employer can maybe use some of those savings to support the employee, as well as obviously, this is coming off the back of a tax rise. So a lot of the times you will keep those savings in the business. But effectively, here are some of the choices that you have with those kind of things in mind around why employees leave businesses. You could keep them, and they could fuel either personal wealth for the business owner, the business growth, or they could just be saved effectively in the business for future. We know it's expensive to lose team members, as we've already said, so the savings could be used to address some of those reasons. So you could use it to improve benefit packages. You could add in things like private healthcare. You could and private healthcare a lot of the time now, with likes of like Vitality, really help create employee engagement in wellness. So again, adding more value to the environment. You could use it to improve the environment, so physically add breakout spaces and use that saving to invest in the physical structure of the business. You can improve team engagement by holding events and socials, and you can invest, like I said before, just invest in team wellness. And either bring a coach in or bring some other specialists in. Something that we're really keen on here at Sempar. We have a yoga teacher that comes in regularly. We have therapists that the team have access to. And we have a wellness coach that comes in on a monthly basis, and that gives us a great, productive, happy team. And obviously, so when we are making these savings, it's just taking a moment to see what you would do with those savings, and whether they are just savings and they're for the business, or whether there's something you can do with them. So, what are the rewards of that? So there's some studies that we've researched and looked into, and I think this is a growing trend. So the 2019 University of Warwick study showed that happy employees were actually 12% more productive. And then there's a further study in 2021 which showed that had grown to 21%, and that was a global study. And I've seen some stats more recent than that where that's even higher. So it feels like there is an obligation or a need to invest in the team to gain more productivity, and you will know, each of you know, that what 12% and 21% more productive actually means in numbers for your business. But obviously they're significant percentages of improvement, and as business owners, you've got to look at the cost versus the benefit of doing something. Teams which are more engaged in well-being are less likely to have time off with illness. So you're seeing that you've got people more consistently in work, and then by means of that, they're more productive. And this is a really interesting one, that a Deloitte study in 2020 showed that employers with a positive work culture and that were focused on well-being had a 30 to 40% lower employee turnover rate. So that's keeping more consistency in your team. It means that the training you're doing, those employees are staying for a longer period of time, which means you're more likely to reap the benefits of that longevity of tenure by the employees. So that it's just really evidences that some investment in culture, well-being, happy workforce is certainly worth it. So key takeaway from just that little interlude is that obviously for a lot of businesses, employees are sometimes the main business asset, and that continual investment does hopefully reap that you'll see optimum performance out of those employees. So just a cultural piece really from me, to also set up Joe's bit on salary sacrifice, and when we're making those savings, maybe there's a little bit of a cultural challenge to think what we do with those savings. So hopefully that's been really helpful. But it gives me great pleasure though to introduce Joe and Pareto, and I'm sure Joe will tell you a little bit more about Pareto and what they do. But we're really pleased to have them as a partner on the employee benefits side, and certainly the salary sacrifice piece. So, Joe, over to you, and we'll pick up questions at the end. So if anyone has any questions, just a reminder to hit the Q&A.
Thanks, Steve and Pete. That's great. Yeah, in terms of who we are, Pareto, we're a financial advisory firm. So we have a financial advisors and an employee benefits team, of which I head that team up. So there's a team of 12 of us in the employee benefits team. We've got about 25 financial advisors. So I've worked in the industry for coming up to 18 years, and I think I've supported over 100 companies with salary exchange. So well versed in all things pensions and salary sacrifice. So if we move on to the first slide, please. So just a little bit on pensions, you might be asking. So I'm focusing here on salary sacrifice. I call it salary exchange purely because it sounds a little bit softer. But in terms of pensions and salary exchange, why am I focusing on that? Well, there are kind of 5 true salary sacrificeable things. One's pensions, one's cycle to work, low emission vehicles, childcare vouchers, and financial advice. Those are your kind of 5 true salary sacrificeable things that HMRC allow you to do. Pensions is the most popular. The reason for that is most of your employees are typically in your pension scheme. Whereas if you operate a car or vehicle leasing salary exchange scheme, then we see kind of anything from kind of 5, 10, 20% of employees doing that. Likewise, for cycle to work, you might have a few employees that want to do that. Whereas in pensions, because all your employees are in there, when you implement salary exchange, everyone would take advantage of it, and as a consequence, so would the company. But in terms of how pensions work, an employee pays in, company pays in. Those are the superpowers of that's number one superpower of pension is your company pays in, so it's kind of free money. That grows with investment returns. The provider that you use will apply a charge, and that charge is because they're investing your money, they're employing people to invest it for you, to give you an annual statement, provide an app, website, etc. And then when you get to retirement, Pete's kind of already covered a little bit, you get 25% of that tax-free and lots of other options. But effectively, you can treat your pension like a cash machine, where you can go and kind of take the money as much as you want at different time periods. That's all up to you. Obviously, hopefully you kind of take advice around that, but the options are kind of completely flexible. So on to the next slide. So what is salary exchange? It's also known as salary sacrifice, but HMRC defines what salary exchange is. They make the rules. It dates way back before auto-enrollment, and it was used as an incentive to get people to pay into pensions rather than rely on the government and using your state pension. So it does provide a national insurance contribution saving to both the company and the employee. And it does it to the employee by providing an increase in their take-home pay. And for those 2 reasons, that's why it's the most popular method in the UK for deducting contributions from people's pay. It is a contractual change, so when companies implement it, they do have to implement it in line with a contractual change, and that can be carried out in different ways. It doesn't have to be physically with the contract. You can do a consultation or ask people to join. Depending on your tax rate, if you're a basic rate taxpayer, you would save 8% of whatever you're contributing, and if you're a higher rate taxpayer, you would save 2%. So it appears less lucrative to higher rate taxpayers, but as Pete already covered earlier in the presentation, there are advantages for higher rate taxpayers being able to get their full tax relief at source when you implement salary exchange. So just going to break that down a little bit in terms of how does income tax and NIC work in the UK. Well, none of us will pay any tax or NIC on the first 12.5k that we earn. Then after that, we pay 20% of income tax, and we pay 8% of national insurance on anything above 12.5k up to 50,270. And then after that, you will pay 40% tax relief up to 125, and as Pete already covered, you will lose some of your income tax for anything above 100. And if you're a higher rate taxpayer, you will pay 2% national insurance contributions. Next slide. So the reason we're showing you that is a kind of good way to show you the difference between not having salary exchange and having salary exchange is kind of thinking about that income tax and NIC. In the UK, the government allows everybody to get tax relief. So it doesn't matter if you operate relief at source that Pete talked you through earlier or pension salary exchange. Everybody gets tax relief. It will be achieved either way. What salary exchange provides is a national insurance contribution saving. So on the left-hand side, we've got here, if you want to pay £100 into a pension scheme and you're a basic rate taxpayer, actually that only costs you £80 because you pay that £80 in the pension, the government will top it up. The way it works is the provider asks HMRC for that 20% and it goes across automatically at real time. So to put £100 in, you don't need to pay 80. If you change the salary exchange, to put that £100 in, it actually now only costs you £72 because you also get the NIC saving by taking it out of your pre-tax and NIC pay. That £100 doesn't receive any NIC, which it did previously. Previously, you would have paid 8% on that £100. Now you don't pay 8% on that £100. So you've saved yourself £8 if you're a basic rate taxpayer. So I'm thinking £8, okay, it's not massive, but why wouldn't you want £8 per month? Pays for your Amazon or your Spotify or your Netflix or any of those kind of subscriptions that we have. And so that is a kind of real positive message to your employees that you can say kind of from day one, you're going to have that kind of increase in your take-home pay. So that's an example for a basic rate taxpayer. And then coming on to a higher rate, very similar, just kind of another superpower of pensions. You've got the first superpower, which is your company pays in. The second is this income tax relief. So if you're a higher rate taxpayer and you want to put £100 into a pension scheme, it only costs you £60 to do that. You get the 20% that's added from the provider, or you go and reclaim the other 20% from HMRC, or you operate salary exchange and you get it all gross. So moving forward, that used to cost you £60. Now it's costing you even less, £58, because you're also getting that NIC savings. So for higher rate taxpayers, that's only 2%, but you're not having to kind of faff about with HMRC to reclaim the other 20%. It's nice and clean, and moving forward, you kind of get that full saving at gross. So a couple of examples, just using somebody earning £30,000 in your organisation. That's close to kind of the UK average salary. So, and then another example for £60,000. So if you're paid £30,000 and you're paying 5% employee contribution, then the cost to you is £125. The monthly cost to you before salary exchange is £100 because we all get tax relief. But moving forward to salary exchange, it would only cost you £90. So in this example, that person would get a £10 increase in their take-home pay. And then again, for a £60,000 taxpayer, there is, again, a small advantage. You would save £5. So you can see pre-salary exchange, the cost to you is £200. Moving forward, that'll be £195. So you get the £5 NIC saving, and also the kind of smoother process of getting the full income tax saving on that. So if you're a company, I've kind of talked through what the employee saving, and whilst it is a really good employee message because you're increasing their take-home pay, kind of the big driver that we get contacted on salary exchange is because there's a company saving there, and Steve kind of talked you through the kind of things that companies use to kind of use those savings to pay for. So this table here is a really good example of kind of what are the typical savings based on your employee numbers. So down on the left hand side, we've got employee numbers that a company might have. So if you've got 75 employees in your company, likelihood is you're going to have a company saving of in and around £20,000 per annum. So, you know, over a 10-year period, you're looking at kind of coming up to close to £250,000. So really good savings to be had there, both for the employees and the company. In terms of our support with companies. Going to just talk you through that very quickly. The first thing we do when we support a company is we sit down and we go through all the rules with them. That is kind of an hour and a half meeting. And you don't come away as a tax expert, but you come away feeling a lot more comfortable with what those rules are. We document those rules, so you've got them moving forward. So anybody in your team wins the lottery and decides to leave your company, somebody else coming in can pick that up and understand how you operate Salary Exchange. We then produce a project plan. It's a kind of 2 to 3 month timeline to get it all in place. Lots of communications are drafted by us for you to email to your employees, including that kind of consultation requirement I talked about earlier to enact the contractual change. And then you have project management calls, supporting with all things payroll to make sure that it's kind of been put in place correctly. Typically, you might do a test member 1 month early just to check everything's working fine. And then a presentation to employees, because it is a hugely positive message to them, and kind of that kind of lands really well right now with the kind of all the things that are happening around kind of the wider cost restrictions. So just kind of going on from the kind of final slide, the last slide there on Salary Exchange. Whilst I'm talking about savings, there are other savings that you can help mitigate some of these NIC costs that we're seeing coming in April. And they are also around pensions as well. So kind of a quick question to everybody on this call. How many people on this call know what's in their pension scheme to the nearest £1,000? But if I were to flip that and say, how many people in there on this call know how much is in their bank account, in their current account to the nearest £1,000? Pretty much everyone will know. But hopefully it should be a lot less in your current account than there is in your pension account. And that's kind of the way in the UK, we're not kind of trained to think about what's in our pension, how much is in our pension, is it going to be sufficient for us to retire? So while Salary Exchange helps you save, when you get to retirement, you're not going to want to be in a position where you're kind of surviving, you're going to want to be in a position where you're thriving. So just coming on to the next slide. If we look at an average person in a company, typically, this is what we would do. We kind of look at their average age, average pension pot, average contribution, total contribution, average salary, and what's their retirement age likely to be. And this is just a kind of an example of one of the clients I visited recently. And it was projecting that their average employee was going to get about just over £200,000 per annum. So you might be thinking, right, okay, £200,000, but what does that mean? How long is that going to last somebody in retirement? And those are things that we kind of help companies look at, because it's important that your employees can retire. Coming on to the next slide. And because that has cost savings to you around your group life, your private medical. If you've got people stuck at retirement age and you're not able to bring in younger employees, that can then become a cost in itself. There is an industry body called the Pensions Lifetime and Savings Association, and every year they come out with what you will need in retirement. And so I put one of their standards on here. They kind of split it into a minimum retirement standard and a comfortable or moderate. But I picked out comfortable because, if we're all honest, we all want a comfortable lifestyle in retirement. But they're saying if you want a comfortable lifestyle in retirement, you're going to need about 43k per annum. Now, Office of National Statistics suggests we're going to live for 20 years in retirement. But if I kind of be more prudent and lower that to 16, then you've got kind of a shorter time frame there, but it's still a long time to kind of have money to last you in retirement. So what that means, if you take state pension out of it, is you're going to need £31,000 to last you in retirement. And that means there's a total pension pot, there's a zero missing on this slide. You need £500,000 in your pension pot, not £50,000. That would be a lot easier to achieve. So what this Pensions Lifetime Savings Association is saying, you need £500,000 in your pension pot. And then on the previous slide, when we had modelled it, and that is typical for lots of companies, it was showing their employees would only have 200. So there was a 300k gap. And that is something we see a lot in the UK. So what can companies do about it? Moving on to other slides. It's a matter of kind of talking to employees, but if everybody on the call can get out their mobile phones and open up the camera. And if you put the camera over the scan here, it'll bring up a link to Scottish Widows. So Scottish Widows are one of the biggest pension providers in the UK. Household name, we've all seen the cloak. But if you bring that up and click on the link, it's going to take you into what's called a pensions mirror. And you've got to allow the camera to take a photo or take an image of you. And as long as it's aligned to your eyes, it will tell you how old you are. And these are things we kind of talk through with employees when we're doing pensions, because it will then say, right, your age. So for me, it's just kind of done, you can't see with the camera, but it's saying I'm age 40, which is younger than my age. And it's saying I've got a 40,000 pension pot. So if everyone can do that, and it kind of will tell them what your average pension pot. It might make you feel better in terms of the pension pot, because on general in the UK we're not saving enough. And it's kind of, as I said earlier, you need to kind of aim for about $500,000 to have a comfortable lifestyle. Everybody has kind of different savings. You might have inheritance, you might have second property, but if you're relying on your pensions, those are the marks to kind of hit. So this is something we would share with employees, just to get them thinking, okay, that's it's guessed my age wrong, but actually I can tweak that and I can see what the average savings is in the UK. And it's a kind of fun thing to show them and get them engaged. So another way we like to kind of talk to employees about pensions is kind of think about it in the days of the week. So if you think of Monday as the day you've just entered the workforce, so you're maybe a graduate or you've just kind of finished school, that's Monday. Tuesday you're age 30, Wednesday you're 40, Thursday you're 50, Friday you're 60. And then on the weekend, Saturday and Sunday, you're age 70 and 80. And not everyone will get this following reference, but in the words of Craig David, if you want to chill on Sunday, you need a good pension pot. And so it's really good to kind of get people thinking, oh God, crikey, I'm on Thursday, I really need to get going, especially after Joe's just kind of said, this is how much I need in retirement. So it's just fun, another fun way to get people thinking, because this does relate back to savings. We have companies come to us and go, Pareto, we've got a problem with exiting people out of the business. Our group life cost has gone up, our private medical premiums are increasing every year, so how can we manage that? And we kind of look at their pensions and go, look, they're stuck, they can't afford to retire. So get that right early. It's not a company cost, you can just make the employees take a little bit more ownership on their savings journey. And then for the younger workforce, because this is people you also need to engage early, is how do we engage? In the pensions world, it's always been the most difficult thing to communicate to a young person, because they're not thinking about pensions, they're thinking about getting onto the property ladder, buying a first car, getting married, etc., paying off the student loan, far from mine. But this slide is so important to explain compound interest, because it shows somebody starts saving age 25 compared to 35, and the importance of being in the market rather than out of the market. And what it's showing is if you pay £5,000 an annum into a pension scheme with 5% investment returns, and you start age 25, you will have close to £640,000 at retirement. However, if you start that 10 years later, you will only have 354. And that is the art of compound interest. And I've got young children, I've explained it to them. If you start a snowball at the top of the mountain when we go sledging, and you kind of do it all the way down to the bottom of the hill, it's going to be a big old snowball when you get to the bottom. If you start that halfway down the mountain, it's going to be half the size. So that's compound interest. The earlier you can stay and get into the market, the better. And this is how we really kind of engage the younger workforce to kind of show financially that difference, if they can afford it, to start paying it earlier. So that's kind of a whistle-stop tour of kind of pensions and salary exchange. So any questions, please let us know.
Hi, Joe. There's no questions on the Q&A, so that means you must have done a very, very good presentation, because everybody's obviously understood it really well, and the same for Pete's slides. If anyone has got any questions, then please drop them in while I'm sort of wrapping up. But we will be sending the video. We've recorded the webinar, so we'll be sending a recording to you for everyone who's attended, and it'll be an opportunity there to come back and ask questions once you watched it again, or you've thought of something after we finished the event today. And if you want to discuss salary sacrifice any further, then there'll be a prompt on that email as well to get in touch, and we can set a call up with Pete and Joe to discuss that with you. So there'll be sort of a call to action on that email. So if there is anything, and obviously most of you on the call have got our contact details, so just reach out and ask any questions, and we can always put you in touch with Joe if it's specifically around the salary exchange. So I just want to thank you all for joining the webinar, and hopefully this is one of many future webinars that will pick on hot topics throughout the year. But thank you for participating and being on the webinar. It's really appreciated. I hope you have a great rest of the day, and we'll see you all soon.